We're analyzing Rowe Price, stock ticker TROW, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Rowe Price. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Rowe Price for your portfolio. Before we get into these valuable metrics, let's understand Rowe Price's stock performance. Right now, Rowe Price trades for $111.96 per share. In the last year, their stock price is down about 20%. In the last 5 years, their stock price is up 2% overall. In the last 10 years, Rowe Price is compounding at 4% annually. They're up 47% overall. Going back prior to the global financial crisis, over the last 18 years, Rowe Price is compounding its stock price at 7.5% annually. The company has more than quadrupled from their lows in March of 2009. Rowe Price is a rare dividend aristocrat from the financial sector. They've increased their dividend for each of the last 35 years. Right now, Rowe Price has a huge 4.3% dividend yield. This is both a strong track record and a very above average dividend. Their average dividend yield throughout this time is in addition to these compounded annual returns in their stock price. Rowe Price trades $20 above their 52-week low. They're down more than $30 from their 52-week high. There is short interest around the business, with about 9% of their shares sold short. Rowe Price is a large business. They have a $25 billion market cap. But why should we be paying close attention to Rowe Price? Rowe Price provides asset management services for individual and institutional investors. It offers a broad range of no-load U.S. and international stock, hybrid, bond, and money market funds. At the end of February 2023, the firm had $1.3 trillion in managed assets, composed of 52% equity, 32% balanced, 13% fixed income, and 3% alternative offerings. Approximately 2/3 of the company's managed assets are held in retirement-based accounts, which provides Rowe Price with a somewhat stickier client base than most of its peers. The firm also manages private accounts, provides retirement planning advice, and offers discount brokerage and trust services. The company is primarily a US-based asset manager, deriving just under 10% of its assets under management from overseas. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. There are 2 key reasons for this. The average publicly listed business earns about a 7% return on capital, and over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. These business returns will be captured here by return on capital. By looking for a benchmark that's double the average, we can potentially build in some margin of safety for ourselves based off the overall quality of the business. Rowe Price earns above average returns on capital in all 5 of these years. They have declined somewhat, and in their most recent fiscal year, they earned about 25% returns on capital. Averaged out, Rowe Price earns about 30% returns on capital in a given year in the last 5 years. This is more than 4 times better than a typical business, and a very strong check on metric number 1. Metric number 2, we're looking for revenue, net income, and free cash flow growth in the last 5 years. This is all or nothing. All 3 of these have to be up for this to be a check. During this time, Rowe Price has grown their revenues by 21%. Their net incomes, however, are down 15%. Looking at their income statement, their drop in net incomes came from a number of factors. The company has increased their selling, general, and admin expenses by $200 million in the last 5 years. More significantly, they took about a $700 million charge between merger and restructuring and a loss on a sale of investments. That's something you can dig into more, and they'll break out in their filings. A bright spot is that over this time frame, Rowe Price has grown their free cash flows by 46%. It's great to see their free cash flow growth leading the charge. Free cash flow is really the lifeblood of any business. Ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business will be worth. We'll be using that exact method later on in our video to come to an estimate of Rowe Price's fair value. You'll want to stick around for that. In the meantime, though, because their net incomes are down, this is an X on metric number 2. Metric number 3, we're taking the perspective of an individual shareholder in Rowe Price by looking for earnings per share growth in the last 5 years. As we learned in the last metric, their net incomes or their earnings are down 15% in the last 5 years. We still want to look at their shares outstanding, and potentially a strong sign for long-term shareholders in Rowe Price. The company has bought back 8% of their shares outstanding. Repurchasing a 1/12 of their business is important here because when you purchase a stock, what you're really buying is a fractional ownership percentage in that underlying business. Still, the decline in their net income is outpacing their share buybacks. This is an X on metric number 3. Metric number 4, we're looking for free cash flow per share growth over the last last 5 years for T. Rowe Price. T. Rowe Price has strongly grown their free cash flows over this time, and with their 8% share buybacks, this leads to free cash flow growth that's stronger than both of these individually. This is a strong check on metric number 4. Recapping where we stand currently, through our first 4 metrics, we're split evenly. We have 2 checks and 2 X's for T. Rowe Price. But there's still one vital piece missing. You might think nailing high returns on capital and having strong growth is the key, but we haven't touched on the one thing that I believe sets truly wonderful businesses apart, which is having these characteristics without using a lot of debt. During economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. In metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow T. Rowe Price has produced in their last 5 years. T. Rowe Price has had negative net debt in all 5 of these years. Currently, after paying their debt, they'd be left over with $1.3 billion in cash. And in the last 5 years, T. Rowe Price has produced $9.8 billion in free cash flow. This is a strong cash cushion, and they're strongly cash flow generative. A very strong check here on metric number 5 for T. Rowe Price. In their most recent fiscal year, the company has produced $2.1 billion of free cash flow, which again is strong growth over this time. Before we get to metric number 6, let's not forget about our bonus. As our bonus, we're looking at T. Rowe Price's dividend profile. Right now, T. Rowe Price pays a high 4.3% dividend yield, and they have a 35-year track record of growing their dividends, meaning they're one of 7 companies in the financial sector that's a dividend aristocrat. Dividend aristocrats are members of the S&P 500 who have consecutively increased their dividends for 25 years or more. This puts T. Rowe Price in special company. Even with their dividend track record and their high dividend yield, people make mistakes all the time by blindly chasing dividends. It's important to stop and look at the underlying fundamentals of a business to see if their dividends are supported. Not only has T. Rowe Price grown their dividends in all 5 of these years, they've also grown their free cash flows per share over this time. They've been able to strongly support their dividend payouts, including a special dividend in 2021, using just their free cash flows and maintaining that strong balance sheet position in all 5 of these years. While this is a snapshot of their last 5 years of performance and no guarantee for the future, T. Rowe Price's dividend looks like it's in healthy shape. The big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will provide a slight risk premium to the yield of the 10-year treasury. It may also offer a reasonable starting point for a fair value of T. Rowe Price. T. Rowe Price has about a $24.5 billion total enterprise value. This takes into account both their market cap and their net debt position. It gives a perspective of T. Rowe Price as if the company were a private business. In the last 5 years, we learned T. Rowe Price has produced $9.8 billion in free cash flow, meaning they produced just under $2 billion of free cash flow in a given year. When we divide that by their $24.5 billion total enterprise value, that gives us around a 7.8% average free cash flow to enterprise value yield for T. Rowe Price. In their most recent fiscal year, the company produced $2.1 billion of free cash flow. When we divide that by their $24.5 billion total enterprise value, that gives us more than an 8.4% current free cash flow to enterprise value yield. Their yields are coming in double the yield of the 10-year treasury and a couple percentage points above that risk premium we're looking for. On both a current and an average basis, this is a strong check on metric number 6. Just because this is the case doesn't mean you run out and go buy the business. This is not financial advice. It's not a buy or sell recommendation of any security. Stick around. In just a moment, we'll get a more concrete estimate of T. Rowe Price's fair intrinsic value. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze T. Rowe Price, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for the business. A DCF model is based off the predictability of a company's free cash flows. It's like any model in any discipline, its outputs are sensitive to its inputs. We're starting with T. Rowe Price's free cash flows and using historical growth assumptions to project these into the future. It's up to you to do your own homework to understand if these are accurate and applicable going forward for T. Rowe Price. If we assume they grow their free cash flows at a rate of 7.5% annually for the next 10 years. Then in the 10 years from there, this growth rate is cut in half, adding in the company's tangible book value, which gives us an estimate of their tangible net worth. If we were seeking a 15% rate of return, which is the rate of return Warren Buffett is looking for from his investments, in addition to his margin of safety requirements, it looks like an estimate of T. Rowe Price's fair intrinsic value is around $117 per share. That's about $5 above the company's current stock price. There are key factors to keep in mind. T. Rowe Price has been a very predictable business in its past. That's not a guarantee for the future. This situation could potentially change for the business. Their 4.3% dividend yield would be included in this discount rate. We would not be doubly counting their dividends, so their stock price would not be appreciating by 15% annually. Keep in mind the strong bull market the stock market has gone through since the global financial crisis. T. Rowe Price could be affected more significantly in a downturn. Those are just just some of the factors to keep in mind. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any potential investment decision, consult with your investment or financial advisor. In just a minute, we'll give our rating to Rowe Price, but we have to address something first. What are the qualitative aspects of the business? Starting with the factors supporting a potential long thesis. Number one, at the end of December of 2022, 87% and 76% of Rowe Price's multi-asset funds were beating their passive peer medians on a 3 and 5 year basis. Number two, Rowe Price has capacity to grow its international fund offerings, such as the firm's organic assets under management growth, which could be bolstered in the near term should performance recover. Number three, with more than $1.3 trillion in assets under management at the end of February of 2023, Rowe Price is one of the larger US-based asset managers. Retirement accounts and variable annuity investment portfolios, which are stickier than retail assets, account for 2/3 of AUM. Then for some of the key points supporting a potential short thesis. Number one, with a substantial portion of Rowe Price's assets generating fees based on daily assets under management levels rather than monthly or quarterly averages, revenue could be more heavily affected during periods of extreme market volatility. Number two, fixed income performance has stumbled as well, with just 53% and 55% of bond funds beating their passive peer medians on a 3 and 5 year basis at the end of 2022. Number three, the company's equity performance has weakened, with just 45% and 53% of funds beating their passive peer medians on a 3 and 5 year basis at the end of 2022. Rowe Price has had mixed fund performance in the last 5 years, contributing both positives and risks for the business. Now it's time for a rating of Rowe Price. In analyzing Rowe Price, stock ticker TROW, we learned the business earns above average returns on capital of nearly 30% annually. They've grown their revenues and their free cash flows in the last 5 years, but their net incomes are down due to some merger and restructuring charges and a loss on the sale of investments. The company has bought back 8% of their shares in the last 5 years. They've also maintained a cash cushion on their balance sheet in all of the past 5 years and have been strongly cash flow generative. On both an average and a current basis of their free cash flow to their enterprise value yields, it looked like those were more than double the yield of the 10-year treasury and potentially offering us the risk premium we were looking for. Rowe Price is a 35-year dividend aristocrat. They pay out a huge 4.3% dividend yield that's been supported comfortably in the past 5 years based off their free cash flows. It's worth reiterating this is not a buy or sell recommendation of any security. This analysis is not financial advice. Before considering any potential investment decision, please consult with your investment and financial advisors. With all the quantitative and qualitative factors of our analysis, Rowe Price looks like a very strong candidate for further research. The company has key structural advantages that could be worth researching. Performing a discounted cash flow analysis of Rowe Price, if you've done the work and you believe those historical growth assumptions from today's valuations of the business, if you were seeking a 15% rate of return, it looks like an estimate of their fair intrinsic value is around $117 per share. Again, that's $5 above their current stock price. It looks like there could be a slight margin of safety in the business. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, comment down below what business you want me to take a look at next time. Thanks for learning about Rowe Price with me, and have a great day.